Alright guys, welcome to the multi-dimensional trading video series. This is our last and final video of the 10-part series. This is video number 10. Today we are going to basically recap and show you every simple common sense concept that we have went over through video number 1 all the way to video number 9. This is on BTC, on Bitcoin. Remember, all the concepts, they work on every chart, every asset, anything that you want to trade. You will be able to use the same common sense concepts on any chart, on any asset. Okay, so let's get into it. We are basically going to show you how it is evident on every chart, on pretty much on any asset. You can use these same concepts over and over to pull money out of the market. Remember, this is not financial advice. This is education only. I do these videos for educational purposes only. I hope you guys get something out of it. This is really the simplest way to trade the market. It's the simplest way to look at it and perceive it. So without further ado, let's get into it. We will start off with one of the first concepts that we went over, which was break evens. Okay, so today I typed in break even zone because I'm using this rectangle box here as the break even zone. But what that means, again, when it comes to break evens, is that people consolidated in here, right? They bought here, they bought here, they bought here in this zone, right? They got flushed all the way out, all the way down. Okay, all the way down. By the time price came back into this zone, break even zone, it was time to take profit, especially if you were long here. It's time to take a short position if you wanted to catch a quick scalp on the short position, right? This where you would have your best opportunity to take it in this break even zone, where these people, these traders, these institutions got screwed, got flushed out here. Okay, they had stop losses, or maybe some of them didn't have stop losses and they lost their shirt. They were in massive drawdown. By the time price comes back up to them, they are at break even, they are at zero. So what do? They sell those positions. They get the hell out of those trades. It's just simple common sense. It's what I would do. It's what the next person would do. If you were in this trade and you bought here or you bought there and you tried to hold it and it went against you for that long and that far down, by the time price got back to you, you would just want to close the position if you were still holding it. And that's what we call break evens. It's as simple as that. We move on to the equal highs. Okay, equal highs is also another confluence as to why you would take your profit here or sell short. Sell short, for the people who are unaware, is when you sell and obviously make money on the price going down, right? So price comes up, it makes equal highs. You see how these highs are equal. This high is equal to this high. We have equal highs after a nice huge run. This is where I would take profit or sell short or take a short position, right? Easy money right there. If you look at the map, we have like 42, 160 something all the way down to 41.5. Okay, that's like a $600 runner right there. One BTC negative short, $600 right there. Okay, that's a really nice short position actually. Okay, equal highs. Now, if I invert the chart, this is also a pro tip, guys. You can always invert your chart to see it the opposite way, and you can use your same concepts. Okay, I'm going to go ahead and type in equal lows. Now, if I turn the chart upside down, which I did, I inverted it, I can use the same concepts of equal highs and equal lows and call this equal lows. You see how these lows are equal. We'll take our brush right here. Equal lows. These lows are equal. So same thing, if my chart was upside down or inverted, I would just sell on equal lows. If you have to look at it like that, that's a really cool way to look at it to get your brain used to taking a short position, because it looks like a long. It looks like, okay, I just need to bet that the chart is going to go up off of these lows. So if you have to use it like that, invert it to see the chart a different way, then do it, because that has helped me a lot. I can look at the chart upside down and see it differently, and it's also helped me with confluences, right? I'm like, okay, well, it also may equal lows. When I turn it the other way, I know I'm running into equal highs. I have a high probability trade to go the other way. It's about to reverse. I have a high probability that it's going to reverse there, right? So that's a really good tip, to invert the chart, because inverting the chart will show you a different perspective, but it also will give you the same opportunity to use the same common sense methods, right? Okay, so we can recap on the bubble theory next. Okay, the bubble theory is the way we find liquidity. We want to know how far down can the price go, right? We want to know how deep is the liquidity pool? How far can price run down? What is the probability where price will bounce, where liquidity will be taken? Okay, so what we do is we take a trend line and we go from this low to this low. Now, this works in a market that has trended up, or trended down, right? But then this example, we're looking at it from taking a long position perspective. But all we're doing is we're drawing our trend line from this low to this low, a trended up market. And then we take our brush and we draw it along the trend line, and then we try to make a circle coming off that line. Where we land is where liquidity is. This is where liquidity is. Where we land is where liquidity is in that bubble. It's the bottom of the bubble is where we land. If you took your brush and you followed this trend line and you tried to draw a circle coming off of that trend line, where it stops here at the bottom, where it cups around, this bottom is where liquidity is found. This is where we have high probability to take our trades there. We show in multiple videos, even a live trade, I believe in video 5, where I take a long position on the DXY after it ran down into the bubble. Okay, you guys can watch that on video number 5 to see a live trade taken based on the bubble theory. Bubble theory is where we find liquidity. If you look, the markets was propped up, big old bubble, it has to get popped. That's the bubble theory. These bubbles are going to get popped eventually. Runs down into this bubble. Look at that. Propped up market runs down into this bubble. gets real violent the closer it gets down into liquidity. Okay, remember, people are here, their orders are here, their stop losses are here, people are buying. Liquidity is down here somewhere. With the bubble theory, we're targeting the bottom of the bubble so we can get in the best possible trade. Okay, look how far it ran down. Look how it ran all the way down into the bottom of this bubble. Price ran down all the way into the bottom of this bubble. And then what did it do? Shoot straight up. In and then out. This is where we would go long. In this area, the bubble theory, it works on multiple charts, multiple assets. You can do this on any time frame, over and over. It's where we find liquidity. Okay, so we can use that also in conjunction with the liquidity grab, right? It's where we go long. Okay, this all lines up too perfect. It lines up so perfect. By liquidity grab, this is what we're looking at. We're looking at these lows. We're waiting for these lows to be broken, because what is below these lows? Liquidity, stop losses, take profits from people who were holding short positions. Everyone is agreeing on a price down here. People who went long here, people who went long again here, they set stop losses at these lows. They are below these lows. They want to give their trades a little bit of room. Every trader is a little bit different. Everyone's risk profile is slightly different, so they place their trades lower and lower. Depends on what their risk profile is or how much they are able to handle. It lines up perfectly with the bottom of the bubble. Liquidity gets taken here. It's a grab. It's the bottom of the bubble. It's the bottom of where everyone's stop losses is at. Everyone went long, consolidated here, flushed out. This is where we go long. We go long on the liquidity grab. Okay, we know we're at the bottom of the bubble. We know we watched it consolidate. We watch it break for the liquidity grab. We know we also are at the bottom of the bubble with liquidity. This is where we would take our long position. And then to add our other confluence, it would be the number signals. Okay, look at that. The number signals. The number signals gives us a clear signal that it's time for reversal. Okay, it's another confluence to add to your trading that will make you very accurate. The number signals. As you can see, price came all the way down and it pumped pretty dang hard off of 40,666. That's a number signal. Okay, price ran all the way down and we pumped really hard off of 43,369. Spiked super hard. Right after the liquidity grab, it ran right into our number signal as well. We would know to even punch in the number where to buy at before it even happens. All we would do is draw our trend line or write our horizontal line lining up with that number. We know where to get in based on these number signals, where price will most likely reverse based on these number signals. Even if you took it off of 4666, you still would have had a huge nice pump. It went from 4666 all the way to 41.3. That's already over a $700 move. Think about it. That's crazy. One BTC, already $700 off that move. Now, if you bought the liquidity grab, the bottom of the bubble, clearly you would have had the best position, right? Because we went from 43.69 all the way up here to 42.1. Okay, that's huge moves. Okay, that's almost $2,000 of a move on BTC. Okay, that's a huge move. 2,000 points almost to the upside, right? Just following these simple, common sense concepts, setting up your trades, simple, common sense, okay? And of course, we would have looked to take profit in this area because we ran into equal highs. We ran into the break even zone where we know people were hurting, where they got flushed out, where they would most likely sell. By the time price gets back to them, they would sell. So guess what? We sell right along with them. We either go short or we close our long positions right along with these people. Simple as that. We understand how they feel, so we understand what we must do as well. It's common sense. Okay, we use common sense concepts here in multidimensional trading. This is how we do it. This is how we get down. We do this over and over. This happens on every asset, every chart. Okay, you can use these simple common sense concepts on any chart. You look for the break evens, you look for your equal highs. You can easily draw the bubble to find out where the bottom of liquidity will be, where the price will most likely stop and reverse. You draw your trend lines against the lows, so when it does break, you understand you have just witnessed a liquidity grab, and that's where you would take the best position long. You can see your equal highs is where it would be the best position to go short. Okay? Especially if you're a scalper and you just want to get in and get out of a good trade. Equal highs and equal lows is one of the best things to do, because you know what, the first touch, it's gonna give you a good bounce. Okay, that second and third touch, I'm not sitting there waiting for it to bounce there. I'm waiting for it to break, most likely. But on that first run to the equal highs or equal lows, whichever way you're looking at it, you can usually catch a nice pump, right? Or if you're looking at it as equal highs, you can catch a nice dump. Okay? Super common sense concepts. You can do this over and over. And if you guys want to get real accurate and more confluence with your number signals, watch this number signal. Very easy to see. Okay? I'm going to go. Look at that. 42,166.6. Super accurate. Like, it touches the very tip of that candle. So if you were wondering where to put my limit order, where to take my trade into this break even zone or into these equal highs, you could literally typed in that number or put it before the number, but you would have been stupid accurate typing in that number. You would have caught the tip of this run to the downside. You'd have been in the very top. It wouldn't have gotten any more accurate than to be right there. Okay? You'd have been at the equal highs. You'd have been inside of this break-even zone where everyone got flushed out. And then you would have had the number signals telling you exactly where the number would most likely reverse at after it touched the very... All that is a confluence. All that is multiple confluences. Very easy to understand. And the reason why the number signals work the way they work is because people throughout the world, throughout society, we see certain numbers, we hear certain numbers throughout our lives, in school, throughout religion, throughout the news, throughout gambling, throughout any type of thing that goes on in our lives, throughout movies, throughout books, right? Throughout cinema, throughout plays, through anything that has been going on in people's lives, those numbers resonate with them. So people come to the screen, they come to the charts, and they type in those same numbers: 666, 369, 777, 420, 444. 316, 333. Okay, these numbers are something that almost everyone recognizes throughout the world in some shape or form, right? So it's really easy to see why a chart or the price would be structured around these numbers, right? I don't care if you're an institution, I don't care if you're a retail trader, I don't care if you're the biggest, largest institution there is, you still are a human and you're still going to type in a number that resonates with you. Okay? So it's just how the market works. It's structured around very specific numbers because the masses, we all do think alike in one shape or another. We are all human and it is what it is. And this is why it's easy for us who are aware of this at multidimensional trading to use it to make money, to use it to our advantage, to pull funds from the market. Okay. This has been video number 10, guys. This is our last and final video of the multidimensional video trading series. So all you guys have to do, like, subscribe, visit us on x.com, which is formerly Twitter. Visit us on Instagram. Subscribe, follow us. We also have our multidimensional trading premium access, which we offer live Q&A, simple charting, our private mentorship, our live trading. You can treat the live trading once again like signals if you like, where we show you guys our live trades that we take. You can join those trades if you like at your own risk, of course, but we take really good trades based on our common sense practices. Get access, that's $8 a month. Cost less than your Starbucks coffee. So yeah, get in. And I will see you guys later. There will be more videos coming. However, this is the end of our 10-part series, our educational series. Remember, there's nothing in any of the videos that is financial advice. This is all for educational purposes. Trading obviously has risk. Like I tell everyone that I meet, get TradingView, download TradingView, paper trade, practice, use these concepts over and over, get it down, get the practice down, get the confidence, build the confidence in your ability. Okay, do this over and over. Repetition is what will build the skill and build the confidence. You see it happening over and over. You know that it happens over and over. It almost feels like you can predict the future just because you see it so much. So I will see you guys later. Hope you guys enjoyed the series and found it helpful. If you did, go ahead and smash that like button. I will see you guys in the next one. Peace.